Let's talk a little bit about bull put spreads. As the name implies, this is a bullish trade, so ideally we're going to get a security that is already in an upward trend, and if at all possible, giving us some kind of bounce off of support. Now today is Tuesday, February 17th of 2026. A little bit of turmoil's going on in the markets right now. This is our SPY, copycat of the S&P 500. If we were to drop a marble or a ball on our 30-day moving average here, it would roll downhill to the left. So that's a reasonable indication that we are in an upward trend, or at least in this case, flattening. Now, if we look at the right-hand side of the screen, I'm at a level of 676.47. So if we were to place a trade that was a little bit below that level, we should at least have some support going our way. Now I'm looking at a short time frame. I'm only going out here to this Friday, February 20th. 676 is right here. If we were to sell this contract, buy this contract, we're tying up very, very little money, and we're bringing in roughly a 20-cent credit. So our payoff profile would look like this. Now this is not a great looking profile, right? We could lose 4 times as much as we could make. I'll lock it here at 20. So our reward to risk ratio is only 1 in 4 or 25%. But our probability of having a winning trade is really quite good. I'm looking at a chart here originally made by Thinkorswim, and you can see this grayed area. That is 1 standard deviation for the time frame I have selected. So another way of looking at that is there's only a 16% chance statistically that we would run below this level of 675. Now, statistics are not the best way to look at the stock market, but they are a way to look at the stock market. We identified that the initial credit is the best that we could do in this trade. The worst we could do would be to take the difference between the strike prices, that's obviously 1 point, and subtract out our credit. We would suffer this largest loss if we drop below our long strike of 675. Now we are doing this based on where I saw the chart, and we could be more aggressive if we wanted to. Let's take a look at a more aggressive trade. So I'm back here to our order entry, and I'm going to go short 680, and I'm going to go long 679, and I'm going to unselect our first vertical, and let's take a look at this one. Now you can see that our payoff profile is a little better. We can make 28 cents, so we could only lose 72 cents, so our reward to risk ratio is better. What is not better is our probability of a winning trade. Now let's look at one more. Now this time I have pretty well gone at the money. My short leg is 683. My long leg is 682. And what our profile looks like now, again, more risk, a little bit better reward to risk ratio. So the more aggressive I get with the trade, the better the reward to risk ratio is, but the more I need to be correct in my forecast that this is in fact going to bounce up. That may or may not happen. A lot of what you do will depend on how accurate you think your forecast is, how much confidence you have in it. Now I've chosen really short time frames in these 3 examples. I've gone back to the first trade that I was illustrating. This is one where we had a lower reward to risk ratio, but a higher probability of success. I can go out in time. Here's another week out. And if I do that, you can see my reward to risk ratio gets a little better. A little bit surprising to me, our probability didn't change that much. It's changed a little bit, but not a whole bunch. What if we go even further out in time? Let's stretch it out another week. Not much of a change here, but we did give another, in my mind, another week for the trade to get into trouble. So depending on my forecast, I might very well go an additional week out to the 27th from the 20th, but I would not go out further, at least not with these strikes. Now another thing that I could do would be to make a little bit wider spread between these two. So I'm going to come here and I'm going to put my long leg just even one out, and you can see that gets me a bigger credit, and it changes me from about 1 in 4 to 1 in 3. And it also does something else for me. It gives me a faster time decay. It gives me a faster theta. And the reason for that is, if I look at my column here for theta, and I'll go back to where we were initially, we had paired these two together, okay, and we do have a slightly faster theta on the one that is closer to at the money. That's exactly what we'd expect. But if we make the spread twice as big, we go with 674 on our long leg. Now look at how much difference there is in the theta. We've more than doubled it. So if you weren't locked into holding the position until expiration, you might very well choose 2 spread instead of the single spread I showed you at first, because you'll get a faster time decay. You'll have a winning trade that's faster. All right, any questions on this, reach out to me. Good luck out there, everybody.